Hi, everybody. Good afternoon. Good morning to some of you. Thank you for joining. Good to see everybody. We've got a good group today. So we'll go ahead and get started and jump right in. So we're joined today by a very, very special guest. He is a mentor to the Duke UNICEF Innovation Accelerator. He's worked closely with several of our entrepreneurs, helped them get from point A to point B with their products in an incredible fashion, help them think about things that they weren't thinking about, which is something you're going to learn about today, the cost of goods sold. So we're just really, really thrilled and excited to welcome Dr. Michael Mosherosh. He is the Director of R&D at Johnson & Johnson. Michael, again, as I mentioned, is a trusted and valued mentor to us. And he also has 25 plus years of experience in consumer research and health products in both North America and Germany. In his current role, his main focus is on social innovation, so he knows the space very, very well. And he works on finding and incubating health-related startups, primarily in sub-Saharan Africa, and he holds a PhD in chemistry from the University of Stuttgart in Germany. Dr. Michael, welcome. We are so happy to have you.
Thank you so much for having me. Let me share my screen. Here we go. And let me put this on slideshow. Can you see the slideshow?
Not yet.
Not yet. Should be. Let me try this again. Can you see it now?
We can see your slides, but it's not in slideshow yet. They're perfect.
All right, we got it. Okay, so let me start. So first, thank you so much for attending this seminar, which is about the topic cost of goods sold. It doesn't sound particularly attractive, but trust me, it's important. And sometimes it can actually be quite interesting. So my name is Michael Mosherosh. I work for Johnson & Johnson. Taylor already said, I'm a director in R&D and I work in consumer products. I have about 28 years of experience in developing products and technologies for the consumer sector. In the last 7 or so years, I have been focusing mainly on social innovation, sort of incubating and mentoring startups in sub-Saharan Africa. My background, and as I said, is I have a PhD in chemistry from the University of Stuttgart in Germany. So I was born and raised in Germany, but I live in the US since many years, and I am located in Skillman. My office is located in Skillman, New Jersey. That's at the East Coast, close to New York. So the first most important thing is there's a disclaimer. As you just heard, I am not a finance person and I am not an accountant, right? So I'm a chemist. What I am sharing with you today is somewhat of a brief overview based on guidelines and experiences that I gathered over the years. If you really want to do this right, consult with an accountant. There are so many different variables, in different countries. You need a professional accountant to do this right. What I can give you here is sort of like a rough idea, a rough guideline. But if you want to do it properly, use an accountant. So don't come back and say like, hey, it didn't work the way you said. So I am not, as I said, I am not an accountant. All right. So what we're going to talk today about is the cost of goods sold, why it's important, what are the elements, how can you improve it, and then, how can you deal with changing cost of goods, and what are the impact of inflation and other factors. After that, I'll demonstrate a very, very, very simple Excel tool that I've often used over the years to sort of get a rough idea on cost of goods sold of a particular business. And Jamila, who is my mentee right now, will volunteered or was voluntold, whatever you want to call it, to share a little bit her experience, because she's been working with me and she has been using the tool, and I think it's a better perspective to her, somebody who's actually using it, than just the person who is telling you like do this or do that. And at the end, there is time for questions and answers, or at least I hope I have answers for your questions. With that, let's start with this whole thing. So what is cost of goods? So cost of goods is the cost of producing goods sold by a company, right? I mean, the name kind of says that, and it's often abbreviated with COGS, cost of goods sold. There are different definitions for the cost of goods sold, depending on who you talk to and which textbook you look at. For my purposes, the cost of goods sold include all the costs that incur producing a product and getting it to the point of sales, meaning getting it to your customer, right? The person who pays you money for it. And that doesn't mean only products. It can also be services or things like that. I mean, the tool is designed more for products than for services, but it can theoretically be adapted to services if necessary. And it's really to have your cost of goods, have a good grip of your cost of goods, because it helps you to figure out what should be your price, what's your profit, it helps you with budgeting. It can guide you in where to focus if you want to do cost improvements, and it helps you with the overall financial planning of your business, okay? Now, what are the elements of the cost of goods? I mean, the most obvious thing is materials. And when I talk to startups, very often I hear like, oh yeah, we know our cost of goods. Here's all the materials we use. And then I say, well, what about your salaries? What about the wages? What about the electricity consumption? There's a lot of other things that play a role. The materials is the most obvious one. One of the things that's a little bit tricky with materials is that it means that all the materials you purchase, right, that you use to produce a defined number of units. So I give you an example. If you buy enough material to make 10 units, 10 products, right? And of those 10 products, you sell 9, and one doesn't meet your specification, the quality is not good, or you give it away or something like that, meaning you're not selling it. The cost of the 9 products will have to cover also the cost of the 10th product, right? Or if you make 10 products and you can only sell 5, those 5 that you sell, that cost needs to cover the cost to make all 10, because you pay the money for the raw materials to make 10, so therefore you have to cover your cost. I know it's a little weird, but when I'm talking to the tool, I'll explain it again a little bit better. Another element is labor. I mean, all the salaries and wages. I mean, if you are running your own company, I mean, you would probably in the long run want to pay yourself a salary, right? You have to, your time is not free. Everybody who works for you, the time is not free. Make sure that you cover that. Then there's something that's fixed overhead. That's cost that comes every month and actually doesn't really change significantly from month to month. Like, for example, if you have an office, you have to pay rent, or if you have a factory that you don't own, you have rent, you have a mortgage, you might have to pay for maintenance or something like that. And then there's variable overhead. That means those are costs that might be changing from month to month, like your water consumption. How often do you flush the toilet per month, right? It could have an impact. Do you employ temporary labor in a month or not, right? What's your distribution cost? How much does it cost you to get your product to your customer, right? Do you have travel expenses, or do you need new pencils for your office or something like that? That all plays a role in the variable overhead. Waste, as I said, is all the cost that's associated with products that don't meet the specification or cannot be sold. you have to cover the cost for waste. If you don't do that, you're very likely losing a lot of money. So make sure you have a very good understanding of your waste. How many of your products that you are making in a given time can you sell, right? And whatever you not sell, that's your waste, even if they're gifts. Depreciation, and I'll talk about depreciation a little bit more in detail later. But depreciation means that let's say if you have a piece of equipment that costs you $12,000, I use this example here because the numbers are easy, and you know this equipment will last me 10 years, and after 10 years, I have to replace it. You have to account for that, meaning if you don't save enough money and your machine breaks down after 10 years, you can't buy a new machine and your business is out of business, right? So what you want to do is if you say it's 10 years, so you have to save every year $1,200, $1,200. That means you have to save about $100 per month, so that after 10 years you have enough money to buy a new piece of equipment if the old one breaks down. If it doesn't break down, that's great. Then you're saving money because the machine is fully depreciated, but you still have to have enough cash or enough money available to replace equipment if it breaks, and you have to take that into account. Transport and distribution is the cost to get products to your retailers or to your end users or to distributor, whoever you are selling it to. And my experience is, depending on the season, that cost can vary quite a bit. In the dry season, it's easy to get to places, and in the wet season, it can be quite challenging and much more costly to get products to your customer. And then one thing that you also want to keep in mind is warehousing. If you are storing an inventory of material or finished goods, normally warehousing does cost you some money. I mean, rent or something like that. I don't talk too much here in this about marketing costs. Obviously, you have marketing and sales costs. Your sales force costs something. It's going to be covered in the P&L, which stands for profit and loss sheet, that I'll talk about in a few minutes. Now, let's look at the cost structure, right? How can I improve the cost of goods? If you look at this slide, there you see 3 pie charts. Let's start with the one on the top right. That's the total cost breakdown. So you can see that, okay, of your total cost of goods that you have here, is the material is about a little bit over 50%, your labor cost is almost 40%, and then you have utility costs and other costs, which might be marketing and some variable overhead and things like that. Doesn't really matter. The point is, if you want to make a cost improvement, the 2 areas you really want to look at is your material and your labor. Because if you cut the material in half, you're going to save a lot of money. If you can cut the labor in half, you're going to save a lot of money. If you cut the utilities in half, you save very little money. So the effort in trying to reduce your utility cost is probably not ideal allocation of your resources. You want to focus on, can I reduce my material cost? Can I reduce my labor cost? Let's start with the material. Can you reduce the material cost? There, it's very important to understand, where should I look, right? So if you look at the chart on the bottom chart on the right, it says the raw material breakdown. In this particular product, it's a fictitious product. You have 5 materials, and then you have some packaging material. I call it unit packaging, carton, and pallet, right? So you have those materials. Obviously, the one material that you want to look immediately, where you have to ask yourself, can I get this cheaper? Can I reduce the cost, is material 3, the big gray one. That's over half of your material cost. So if any improvement, cost improvement or lower price that you can get for that material will really help your overall cost. On the other hand side, if you look at material 4, that's 1%. If you halve the cost of that material, the impact on your total cost of goods is minimal. It doesn't really matter. So don't worry about material 4, worry about material 3, worry about material 5. Those are the first 2 of the highest priority, because if you make even a small change there, it will have a significant change on your overall material cost. The other one that besides the cost of the material for buying the material, the other thing that you have to think about is, can I reduce my material consumption? Can I make my product using less of a material? That sometimes helps too. So for example, if you are cutting out stuff, like, let's say if you make cookies, right? And you cut out cookies and you have a lot of stuff left over after you cut out your cookies, that's all waste. You can't really use it, right? But if your cookie shape is, and let's say you use a round cookie shape, right? You have like a lot of holes in a flat piece of dough. But if you make squares, you can actually use the entire dough that you have, because you don't have those gaps between the circles, right? I don't know if that's really clear, but what you want to try to do is you want to use your material as efficient as possible, so you reduce the consumption a little bit. The other thing that you can look at is the labor, right? Can I make the same amount of products or the same number of products with less labor? Do I need all the operators that are making the products? Is it really worth having a director full-time? Do I need a director full-time? Can I have a director only for, half of the time? Something like that. Do I need an accountant? Generally speaking, yes, you do. But you have to look at, who do I pay my salaries and my wages for, and can I reduce that cost? You can also improve processes. So that means, instead of you needing 5 people to make 100 products a day, if you improve your process, you might get away with only 3. So you can essentially create the same number of products with less operators, which again, reduces your labor cost, and it lowers your cost of goods. And then lastly, reduce waste whenever you can. I mean, if 10% of your products don't meet your specification, try to improve the quality of your product so that only 5% or only 1% don't meet your specification, because then you can sell more and you don't have to cover the cost for those products that don't meet your specification, or that you give away. I mean, great example is buy one, give one away. That means the cost of goods for the one that you buy has to cover everything for the 2, because the giveaway is not for free. You paid for all the material and the manufacturing, etc. So the cost of the one needs to cover, or at the price of the one needs to cover the cost of the 2. I hope that that's kind of clear. So there are no freebies here anywhere. So one of the things that happen all the time is that the cost of goods is changing, right? So there can be variations, and they kind of make accounting a little complicated. It could be the raw material prices. Last month it cost you $100 per square yard, and this month it cost you $200 a square yard, something like that. And that can be caused by inflation or currency exchanges. Sometimes it's taxes or duties or whatever. There's many, many different reasons why things can change. To deal with this, my recommendation, there are many ways of doing it, right? So I'm not saying this is the only way. I'm just saying this is what I normally do, is I define at the beginning of the year a standard cost of goods, where I make an estimate for all the materials. Okay, this is what it's going to cost. This is about the standard cost of goods, right? And that's an assumption, and it's normally wrong because things change. And then what I do is I actually record every month the actual cost, the real cost, right? And then I always record the difference between the standard and the actual cost. That's the thing that is important for you, again, in the profit and loss sheet. That's where you really want to make sure that you capture everything. Because if you're working off the assumption, oh, it's my standard cost is correct, and your raw material cost doubles, everything is not going to work, right? So you always have to make sure that you reflect reality. But for accounting purposes, it's sometimes easier to work with the standard, and as long as you capture the difference between the standard and the reality, you're okay, right? Just make sure that you don't lose track of that. There are other variabilities that are covered in a profit and loss sheet. So I mean, maybe you have more or less employees in a month, or your wages are changing. People are getting a salary increase or something like that. Cost and consumption of utilities can change. Electricity prices or energy prices can go up. Gasoline can go up. Your marketing expenses might change quite a bit. You might have a campaign in one month and nothing in another month. So all that stuff plays a role, and that can all be covered in a profit and loss sheet. Office expenses, you need new pencils or whatever, that should actually all be covered. The more information you have and the more detail you have, the more accurate is your estimate using this. But again, it's an estimate. If you want the real number, work with an accountant. Can't repeat that often enough. Then yes, inflation, currently a big problem, right? The inflation results that the cost is increasing over time, right? The material, the wages, utility, as I just mentioned. So what can you do about it? Well, there's several things you can do. You can look at cost improvements. Can I make my product cheaper, right? For me to the cost for me to produce the product, can I make it cheaper? Use less material, use cheaper material, things like that. The next question is, can I increase my price? Can I make my product more expensive so I can cover the cost, the increased cost that occurs to me, right? That might work, or your customers say like, well, no way, we can't do that. We can't give you that. Another thing is you can say like, okay, maybe I can reduce my profit margin. If I had a profit margin of 20% for my product, that means the difference between my sales price and my cost of goods is 20%. Maybe I can live with 15%, right? So then your profit is smaller. You don't change the price, you don't change the cost, but your profit goes down. And then the last one is a little weird because inflation, is continuous. You might want to consider to have a larger inventory of material. So that means if you buy a lot of material now and you know that your inflation rate is very high, that means your material is going to be much more expensive further down the year. It might be worth to buy a little bit more material. That obviously depends very much on how much cash you have, like your cash flow, because all the material that you buy, that cash is locked up. You can't use it for anything else. So it's, again, this is something you need to discuss with your accountant. What is the best strategy for you to address inflation? Another one, and that's often a big problem, that is supply chain. So the transportation of materials or finished products, specifically in Africa, is actually quite expensive. It depends a little bit on where you are, but generally speaking, it is pretty expensive. And especially if you're importing things, let's say from China. If you 3 years ago, a container full of a material, the transportation cost per container would be $500. Today, it might be $1,500. It might be $5,000. The material transportation cost has changed quite a bit, and that can really affect a business quite significantly. So to address this, you can think about larger shipments. If you do a larger shipment, you don't have to ship it so often, so you don't have to pay for shipment so often, and it tends to be more efficient. But again, in that case, what are you going to do with all this stuff, right? You need to warehouse. You can also think about, can I find other suppliers that are closer by, that I don't have to transport my material so far? Or do I have a distributor that is closer so I don't have to drive my product so far? And then the last one is, you need a good lawyer for that, but if you can make binding contracts. So if you make a long-term contract with a supplier, for example, say like, okay, the landed costs for my material will be whatever the number is for 2023, right? And when I say landed cost, that means the cost that you pay for the material to stand at the entrance of your factory or your business, right? It's not at the port, and it's not at the supplier, it's at your door, because you have to include all the transportation cost into your landed cost, right? Another one that's very, very tricky, and I found this, I mean, in Africa, I had a couple of situations where it was horrible, right? So it's the lead time for orders. So we ordered the material, and it took 6 weeks to get the material delivered to the door of the factory. And so we said, like, okay, the lead time for the order is 6 weeks, right? The last thing that you want to have happen to you is that you have orders, you have machine capacity, and you don't have raw materials, so you can't make it, right? Because then you're paying every day that you run out of stock of raw material. You run your equipment, or you own your factory. You have fixed costs coming in. It's going to cost you money, and you're not making any money because you're not producing anything. So first thing is, you really have to have a really good understanding of your inventory of materials. You need to know when you think you're going to run out, right? So you need to talk with your forecasting. How many do we have to make? How many do we have to need? You have to really understand very well how much material is there. What also helps is if you talk to your suppliers and make sure that they can guarantee you a delivery time, right? If they say, yes, we can do in 6 months, or we can do in 6 weeks, you know that 6 months or 6 weeks before you run out of that material, you have to order in order to get the material to your factory so you don't run out of stock, right? Again, larger orders might help if you have warehousing capabilities. And again, binding contracts might also help, that you put into the contract and say, like, okay, we expect the delivery time to be such and such, and otherwise, there's a penalty or whatever. Again, you need a lawyer for that. Warehousing, as I mentioned before, if you have a lot of stuff sitting around, you're having a lot of money locked up in it, but you also have to most likely pay rent or maintenance, or a guard or something like that to do your warehousing properly. All right. A little bit back to fundamentals: cost of goods and sales price. Okay, so the profit is the difference between the cost of goods sold, and in that case, again, cost of goods sold is all the costs that incur, including marketing, transportation to your customer, everything, right? It's the difference between the cost of goods sold and the sales price, right? If your cost of goods is smaller than your sales price, you're profitable. If your cost of goods is larger than your sales price, you're not profitable. You're losing money. That means every product you sell, you essentially are losing money. And if your cost of goods is exactly the same as the sales price, you're cost neutral. You're not making any money. You're not losing any money. And when I say making and losing money, this is after all the wages are paid, right? So if you pay yourself a lot of money, and that's all covered in your cost of goods, and you're cost neutral, you're fine. Nonprofit organizations, they don't have to make a profit. They just have to be, financially sustainable over time. The key questions that you have to ask yourself is, how much does it really cost me to manufacture a product and get it to the customer? That's why I said, like, you really have to understand your cost of goods sold. The other one, which very often people don't think about, is how much is your customer actually willing to pay for the product? And you can't go to the customer and say, like, hey, how much do you want to pay for this? I mean, they're going to tell you 0. I don't want to pay anything. I want to pay the minimum amount. So you have to be pretty clever in how you find out where is the price that the customer is willing to pay. So you can't give them choices between a higher or a lower price. They always pick the lower. You got to give them individual choices. Say, like, okay, I have this product and it's going to cost XYZ. Would you be interested or not? So you have to do a little bit of sort of market research, and you have to be very clever about it. Never give people the choice between a higher and a lower price, because they will always pick the lower price. You don't even have to do that test. I can give you the results right now, no matter what it is. So really understand your customers, because in the end, the price that the customers are paying for your product reflects the value that your product means to those customers. if they think it's very, very valuable, they're willing to pay you a lot of money. And if they think like, yeah, sort of like, might or might not have it, then, you have to be careful how much you charge, because they might easily say like, well, it's not that valuable. I don't have that much money for something that's not that valuable. I don't want to spend that money. So really understand how much does your customer want or is willing to pay. I mean, want is low, but willing is the one that really matters. And then, also you have to understand how many products do you have to sell to cover your monthly cost, right? That's something that you can do if you thoroughly understand your profit and loss sheet. You have costs that occur every month, right? No matter how many products you're selling. You have to make sure, how many products do I have to sell that at least I cover my costs, so that I'm not losing money every month, okay? So that's very, very important. Many of you might actually get external funding. That could be a grant, or it could be donations, like charitable donations, or something like that. And that's nice. That's really nice. But the ultimate goal of every social enterprise, actually of every enterprise, doesn't even have to be social, is that they become financially viable or sustainable, meaning they make a profit or at least are cost neutral. That means that they're not losing money every month. And so I always tell people, charity is not a business model. You can't say, oh, I make, I get so and so much in donations, I put this in my cost of goods that covers so and so much. No. Because the charity can stop very quickly. You have a global pandemic coming up, and people suddenly are not giving to your charity anymore. They give to a different charity. So the money inflow through charity or grants or general funding is not a guaranteed. What I would always recommend is calculate the cost of goods without the external funding. So you have a really good understanding of what would it cost me to do this alone without anybody else giving me any money? And then what would it take me to become at least cost neutral? If you're figuring out that 80%, or let's say that 80% of your cost is covered by donations, the likelihood that you're ever going to become financially viable is pretty small. I mean, you don't really have a viable business here. You have a donation thing going on, but not really a business, because the business goal has to be that without external donations, that you are at least cost neutral, or even better, make a profit. So keep that in mind. Don't get fooled by money that's coming in from organizations, because it's not going to come in all the time, and it might come in today, but maybe not tomorrow. All right, so a lot of theory here. I will actually share my screen now and show you a tool that I've been using for many years. I've modified it many times for people, and let me sure that I can share this properly. This should be here. Okay.
Looks good.
Can you see you can see my screen? Excellent.
Yep.
Excellent. Let's start here. So the tool is very simplistic, and if there are any finance people on the call right now, they're just they start crying because it's so horrible. But it's not meant as a business tool for you to build your business on. It's a tool that helps you to get a rough understanding of what actually is my cost, right? Where am I with this? And Taylor will be sharing the tool with you, the latest version of it, and it's generic. You can, it's Excel. It's very easy to program. As I said, I'm a chemist. I am not an IT person. I'm a very pedestrian programmer. So it's a couple of formula. That's all it is. I try to make it a little bit easier. So whatever is yellow is stuff that is information that you have to supply, right? And the gray stuff then is being calculated. So you don't have to, if you don't play around with that formula, then, that's your calculation. Let's start from the beginning. So you have, in this particular example, you have 5 materials, material 1 to 5, and you're buying that material in different amounts. So let's say, for example, material one, you buy 100 meters at a time. It's a fabric. You buy 100 meters at a time, and it costs you $20, right? And material two, those are individual pieces. You buy 50 pieces at a time. They cost you $10. That's what you put into those numbers. This is the amount, and this is how much you pay for that amount, right? And then you need to know, okay, of the material, let's say material one, the fabric, how much do I need per unit, right? Per unit that I make, right? So let's say I need 1.5 meters for that, and I need only one piece of material too, et cetera, et cetera. So you fill all the amount that you need to make one piece or one product, you fill this all in, and then it calculates the usage per unit, and it calculates you the cost per unit, right? Now, if you look at the usage per unit, that should actually be 1.500, but it's not. It's a higher number. And that is because I included the waste. Let me just move down here for a second. Here on the bottom is a number. That is the waste factor. That means if you make 100 products, one product is wasted. One product is not being sold for whatever reason. Either you give it away for free, or it doesn't meet your specification, or it gets stolen, whatever. I mean, that product is not being sold. So here's the percentage of the products that you make that you do not sell, right? That percentage is calculated in here to make sure that the cost for that one unit that you don't sell is covered in your total cost, right? I hope that's clear. So, I mean, if half of your product would be garbage, right, or would be wasted, the usage per unit would be twice as high, right? The factor would be 2, because you have to cover all the costs that you have for the materials that you buy relative to the products that you sell. I have some other materials here, like packaging materials, and as I said, like as a bag and a carton, and then a pallet to put it on, and things like that. It's exactly the same calculation. You know how much your bags cost. 1,000 bags cost $50 US. 100 cartons cost you $100, etc. You fill this in. You know how many cartons you need per product. So, for example, here there are 10 products in a carton. There is one product in a bag, and there are, I think it's 1,000. There's 1,000 products per pallet. It's just the ratio. So that is your material cost. That's important. The next thing that you need to figure out is your labor cost. So first thing is you have to figure out, okay, how many people are actually working here, right? So you have a bunch of operators. Those are the people who are actually making your product, right? The people who get wages. And then you have maybe a production lead. You might have an accountant, a director, marketing and sales people, administration. There's lots of other people that you might have, and you have to put them all up here and say, like, okay, so and so many people are there. And then the important piece is to find out, okay, how many units do I produce per person per day? And in this case, I know that I make 250 products per day, right? And I have 5 operators. That means it's 50 units per person per day, right? So for my 5 people, they make 250 units. My one production lead makes 250, the same 250 units. And so they all have 250 units. So you know that the cost of your workers per day is this, and the cost per unit, which is the cost per day divided the number of units, is this, right? How do you calculate a cost? Well, you have to put in here, here's my number of operators. This is how much my operator makes. That's the wages, $1,000 a month. The production lead makes $1,500 a month. I just made up the numbers. I mean, they're not real numbers. So you put all the salaries and wages in here. So with your current staffing, you have $18,000 every month that you have to pay in salary and wages. That is a fixed cost that you have, right? That's their labor cost that you have to cover. And then there's a whole bunch of other costs that individually are not very big, but they add up, right? So your electricity, your utilities, water, office and cleaning supplies. I mean, the smallest stuff that might count. The more details and the more accurate you are, the more accurate is your estimate. Again, it's mainly still an estimate. It is not the absolute number that can only be given to you by an accountant. Rent, you have to pay rent. You can put the water cost, your monthly water cost in here. You can put your electricity cost in here. I have no office and cleaning supplies here right now. You just plop in the number, how much is it, right? And the rent, how much is it? And then you have other things like maintenance, right? Maybe your machine needs electrician every month, and it costs you $1,000 to maintain your machines every month. Maybe it doesn't cost you anything, but there might be certain costs, transportation cost to the customer, to your distributor or whatever, because the transportation cost to your factory of the raw material, that's included in that price. That has to be included in that price, right? But the transportation cost to your customer, you have to cover that here, right? And I would say it's like $500 or whatever. Then you have internet and phone, that costs you some money. And it always calculates here, okay, the cost per day and then the cost per unit. And the number of days I put in here. Normally it's like 26 days per month. Now, if you're saying, well, but I'm working in 2 shifts, right? So what you could do is you could say like, okay, I'm not making it days, I'm making it shifts, and I just double the number, right? So you can do that. I mean, you have to play a little bit with the tool, but generally speaking, you collect all this information, and the information that's the most crucial one in my mind that you really have to understand, besides the cost of raw materials that you have, is how many units do you produce per day? It's easy to find out how many people you have employed. That's an easy one, but you have to know what is the output. What is your depreciation? And I talk about this depreciation in a minute. And also, what is your waste? You have to have a really good understanding of that, because that actually can play quite a significant role. And let's say you have all those numbers together and filled in, then you can go to the cost sheet, and the cost sheet then actually spits out those pie charts that I showed you before. So here's the total cost breakdown, here's the raw material breakdown, here's the labor cost breakdown, and here's the actual calculation, right? So here's what I consume, here's how much it costs per unit, and then the total material cost for our product in this case is $3.79. The labor cost is $2.77. Utility cost is 38 cents, and all the other costs, and again, I have not included marketing, you might actually have to include that, is $7.29. That gives you a pretty good split on where your cost sits and where to focus on if you want to make a cost improvement, right? Now, for the profit and loss sheet, which is here, you look at it a little different. So let's say you start in January, you say like, oh, I sold 1,300 products and I charged $30 per product. It sounds like a lot of money because we just said the total cost of the product is only $7.30 or something like that. But I charged $30. I had no return. So that means nobody came back and said like, hey, that product is no good, give me my money back, right? If somebody comes and says, I want my money back, then you have to put in a number here. That has to be a negative number because you got to give that money back out. You didn't give any discounts to anybody, right? That means, oh, it normally costs $30, but to you, I give it to 29 or something like that. That, if you make a discount, you have to take into account. And I mean, I have an example here. In February, 3 products were returned, and I gave $2,000 of discount. So that's $2,000 less income that I have. And then if you multiply the number of products you sell by the price, and then add up these numbers, here is your net sales, right? This is the money that you receive. And then we said before that the material cost, only the material cost per unit, is $3.79, right? So you calculate $3.79 times 1,300. That's the total material cost. That's the total material cost of goods. Again, only material. And if you subtract the total material costs from the net sales, this is your gross income so far, right? This is not your profit. This is your gross income. Then comes all the other stuff. We said before, we have $1,800 of salaries. We have depreciation. And as I said, I'll talk about this depreciation in a minute. You have to put in your monthly depreciation, your rent, all your costs have to go in. And there's like a whole bunch of other costs that you can in. And then you add all those costs up and subtract it from your gross income. So your income from operations is the difference between your total operating costs and your gross income, right? So in this case, it's $11,320.69. Then, you know, if you make interest on money, you could put that in here. You make a little bit of profit there, or you have to pay interest for money. You have to subtract some money here. You have to pay taxes, very likely. So that needs to go in. That's where that's where you need an accountant that makes sure that you have the right numbers here. But, you know, roughly speaking, your net income is $11,320 when you sell 1,300 products. Now, in February, we sold 2,500 products, right? Our income is 40,000. Same expenses, more money is coming in, difference is bigger. So my profit is 40,625, right? In March was not such a good month, so we only sold 500, right? Now there's a little problem because my net income is negative. That means I'm losing $9,600 that month because my cost is the same, but my income is lower. So my income is lower than my operating cost. So therefore, I'm losing money. And then I did a little played around a little bit, and I said, okay, if I sell 868 products at this particular setup, I lose 48 cents. I mean, I'm cost neutral essentially, right? So I know that at least I have to sell 868 products per month to cover my expenses, my total operating expenses, right? All right, last thing that I quickly want to, and you do this every month, right? And then, you know, as I said before, this is using a standard cost. You have to sort of like run in parallel, what is your real cost? And then you have to make a comparison. It's a little complicated. And that's, again, you know, you need an accountant to do this right for you. And then you add everything up over the year, and then you know how much money you make, right? I mean, obviously it's negative here because, you know, May, June, we haven't sold anything yet. If I put in numbers, then you can actually calculate what is your net income per year. Depreciation. Depreciation is sometimes a little bit of it took me a long time to really understand. But if you say, okay, I have equipment and that lasts a certain amount of time, that means I have to replace that equipment after a certain amount of time. So in this, I made an example here. I said, okay, you have a machine 1 that costs $36,000, a second machine that costs only $5,000. You have certain tools that cost $1,000, and you have 2 computers that cost $3,000. Now, you look at the machine and you say, like, okay, the machine and the machine 1, machine 2, and the tools will last for 7 years, and then I will have to replace them. But the computers will only last for 3 years. Then I will have to replace them because computers tend to be upgraded very quickly. So you have to do this here properly, right? So that means that you have to have enough income that you accumulate enough money that after 3 years, you can buy another 3 computers for $2,000, right? And for the machines, you have to have enough income, depreciation, that after 7 years, you can buy a new machine, right? New machine 1, new machine 2, new machine, new tools. So what does that mean? In year 1, at the end of year 1, you have depreciated $5,000 of machine 1, $700 of machine 2, $140 for the tools, and $600 for your computers, right? So your total cost per year of depreciation is this is a very odd number, right? This is a little bit over $6,700, right? The remaining that you have is $3,600 on $36,000 on your equipment, and the remaining value of your computer is $1,300. So you paid off 1/3 of the computer because the computer has to be paid off in 3 years. After the second year, you have paid off 2/3, so you have only 1/3 left. And after the third year, you have the computer paid off, right? That money is not money that you put in your pocket and spend, but this is the money that you have to take care of, that you have it available after 3 years when you have to buy a new computer. This, and the money that you're using in depreciation, that has to be the money that allows you to replace the equipment after the lifetime of the equipment. For the machines and the tools, as we said, it's 7 years. So here's the calculation, how much you have to pay every year, and then how much money is left. And after 7 years, the value of your equipment is 0, right? So it's all fully depreciated. Now, that doesn't mean that you have to buy new material. It just means that you don't have to depreciate it any further. If the machine works 3 more years, that's great. It actually lowers your cost because you don't have any depreciation. Because you can see the monthly depreciation is in the first 3 years is $550 some, and then in the last 4 years is $500, right? Theoretically, if you buy new computers, you add a new depreciation here and you do the same thing all over again. I hope this is kind of clear, but the whole concept is that you have to plan for replacing your production equipment after its lifetime, after it's not can't be used anymore. And you have to estimate how long can you use it. That's sort of the key thing here. Okay. With that being said, let me go back here. Yep. Do you see the slide?
Yes.
Okay, good. So Jamila, there she is. Hi, Jamila. Good to see you.
Hi, good to see you.
So I have been working with Jamila for quite a while now. And we actually used that tool. We kind of modified it so that it reflects her needs for the Smart Girl Uganda, for the solar backpack that she's producing. And so, I mean, I have to say this, I can't say this often enough. It's a rough tool. It is not exact. It is a good estimate, but it's not exact. So if you really want to do this right, you at some point might want to decide to use real commercial software to do this properly. And you really might want to have an accountant who makes sure that all the numbers that you're putting in are right. I'm not guaranteeing that I'm covering everything here, but it gives you a pretty reasonable idea in my mind. But now I would actually like to ask Jamila, can you share a little bit your experience of working with the tool? Is it useful, and how do you use it?
Thank you, Dr. Michael. I would love to say thank you so much again. I can't stop saying thank you to you because me being as a person, before I hire staff, I like understanding exactly what I'm doing. And the Solar Smart Bag, as much as we had other programs, it's something that we innovated and we launched very fast, and it grew really fast. So we didn't slow down to really calculate a lot of things. And the moment and Dr. Michael and the Duke UNICEF came into our lives, we're making money, but we're also losing so much money that we did not know what was going on. And already I did not have the resources to hire more staff that was specialized for the Solar Smart Bag. So that's how that tool came in handy when Dr. Michael introduced it to us. And sorry, I wrote down a few things that helped us with the tool that we were underlooking. I'm sure if you remember when I used to introduce my bag, I would always say, with every bag we sell, we make another we give out for free. And yet we didn't know how we're making the money to give out one bag for free. So with this tool, we're able to notice we're instead losing money, and we're not paying ourselves in sacrifice to the bags that we're giving out for free. So the tool helped us understand all the costings, all the raw materials and every single detail we put into the bag, and to understand with ourselves that we were actually losing money with donating a bag with every bag that we make. which was the latter. So with the system helped us, the tool helped us understand with 5 bags we make, that's when we are able to give out a bag for free. So I don't market it anymore. I don't even say it that way anymore, because with the Excel sheet, we're able to see that we're making a loss while with making 1 bag and giving out another bag for free. Another thing that we're not putting in mind that the tool helped us with was waste. We did not know we're not calculating the bags that were not selling off, or the bags that were, you find a light that has gotten broken, and sometimes we would recycle that bag and maybe replace a light, but would forget to calculate that this light that was broken also cost us money. And also, when it came to raw material, yes, we'd recycle it out of sort. Some of the bags would recycle, but still there's an additional cost that goes into recycling that bag. So calculating that waste and understanding it, I remember Dr. Michael kept on asking me and my team over and over again, what waste are you incurring? And we didn't know at all. So it was really good. And we went back to the team and like, but wait a minute, what does he mean? I thought waste is the offcasts we make and we recycle those offcasts. So until he explained to me more that some of the bags that you've not sold, some of the bags that are staying in the store, and maybe you're reusing them, or you're waste, like writing them off, that is waste. And for us, we thought it's the offcasts we're making when we're making the bag. That's what we call waste. The other is transport, this small transport when someone buys the bag as 1 bag. So, being me passionate, I would actually, sometimes people would call me personally, bring me 2 bags, but I'm actually incurring transport. And I would not put that in mind. And he really told me every single cost that you put in relation to the smart bag, you really have to put it down. So we did sit down and notice we're spending so much on transport, and not like bulk transport, but 1 or 2, 3 bags that we're delivering. So we decided to put a delivery channel just to do out of that. Yeah. The other is, of course, personal salary. As we have 2 programs that are going on. We have with the Girls with Tools and the Smart Girls. So we had put a lot of exhaustion on the Girls with Tools, and the Smart Bag was really going through the costs that we're doing. So just having this tool that was specific to the Smart Bag was really enlightening for us, and to really divide the costings when it comes to personal salary, and how we could make sure it is dedicated, and how much the bag is contributing to our salaries, and really creating a line so that we do not have both my programs running into each other, and we know if it's profitable. So that tool really helped me so much understand that. And the other thing was the expenses for marketing. We, of course, were not hiring very fancy marketing, but I used to underlook even the little airtime I'd put on my phone, on Rahma, what Rahma used to use also to market, calling the phone calls. We used to make the endless phone calls, us going to really talk to clients. So we hadn't put all those in place, but Dr. Michael kept on asking me all these questions, and I won't lie, I'm sure he'd noticed the first 2 meetings were like, oh my God, what is this? But it really helped us, and we've decided for our other programs. But for me as a person who is the brains behind, as he has said, a disclaimer, he's not an accountant. He told me this from the very beginning, but me as a person who is designing, who is heading an organization, I do not also have the background of being an accountant, but I really needed to understand this costing myself, so that I would not, if I'm to hire any staff and maybe they mess up with QuickBooks, now you cannot mess up anything, because I really know about it. I know everything that the bag needs. Oh, one other amazing thing that Dr. Michael really made us notice, those graphs that he was showing were quite important, because we're looking with inflation, we're looking for what to reduce the cost or to increase the pricing. And we didn't want to do exactly what he's talking about, go in and tell the people, would you buy this bag for this much? Would you? No. So with us putting down all our costs, we noticed where we're spending so much money, either in utilities, either in, yes, that slide, either in raw material. And we noticed there was a particular raw material, we're spending so much money at it. And the more we kept on talking, he kept on telling me, but can't you reduce this raw material? And I'll give him ideas. I'm like, no, let's reduce on the labor. I said, but if you reduce on the raw material, you're actually going to save much more than the labor costs or the utilities that are not going to go away. And we ended up looking for an alternative. And the bag we are making right now, we are doing more of the plastic waste because it's literally no cost. So it has helped us save so much money, and we are making more profit. We are right now from with Serena Hotels, the fundraising for us the bags, and literally 70% of the bag is plastic waste. So it's through this graph of the raw materials we noticed which part was the drill that was spending. Was it the drill? No, there was something else I've forgotten. Was spending so much money on, and when we were putting in the data, Dr. Michael noticed it, and because he kept on asking, why is this so expensive? Can't you alternate it? You're talking about inflation, which was really cool for me as a person, because sometimes when you have the production team go out into the market and you, the lead, is not going in there, they want to buy the best, but some of them even want to buy where they're making off their cut behind there. But when me as a person, I know the cost of production, I can come in and once do a check, and I'm able to know that I'm not being swindled, or we are doing a very good business. And for me, this is not more of, as much as it's a business tool, for me, it was more for me as a person who's leading a huge team and who is transitioning out of power, that if I'm to come in and do a check, I can always tell, even if they add QuickBooks to it, I've personally understood the cost of the product that I've innovated. Yeah, I think that's it. Thank you.
Thank you so much. That's really great. Thank you. I'm really happy that it helped you a little bit. Did you make any changes to the program or to the tool?
Yes, the changes we made is when we reduced when we ended up alternating the material of the cost that we had, and we actually went in and understood all the formulas that you actually had given us and added some more of ours. We even took it out and used it for our girls with tools. So we started designing it for all the other products in particular to find out if they were also a profit making. Yeah, we did change it. We played around with it a lot. We are still doing so, actually, I won't lie.
Okay, thank you so much. So with that, are there any questions from anybody else in the audience? No? Okay. So
Sorry,
if you don't,
I see Penina.
can you still hear us?
Yes.
Yes, I can.
Okay,
Sorry.
okay.
Yeah, we've got one question in the chat if you guys are ready.
Okay, let me see.
So Nandita is asking, Jamila, did the cost of the bag increase at all when you did this workshop, and how did it affect profit margins, sales, etc.?
So the cost of the bag actually didn't increase. It's the profit margin that actually increased. So because we thought of increasing the cost, and that would be a problem for losing clients, it's becoming more expensive. And the advice Dr. Michael gave me was not to really go out to really see if the cost we're giving was worth the bag. I don't know if you want to see, explain it earlier on. I would go with the bag we've done with all the cloth and everything, and then we'd go with a bag with the ones we've done with the solar, with the recyclable, and just ask the people, how much are you willing to pay for such a bag? We got people saying higher, we got people saying lower, but we decided to just really not increase the price, so that because we've already marketed it that way, but we really worked within the system to understand what was more costly. We were spending almost in raw material that we could reduce, and that has helped us increase our profit instead with reducing the cost of material.
Oh, economy of scale. Yeah, that's interesting. So economy of scale plays, for example, a big role when you look at raw materials, right? And There are several aspects to it. I give you an example. If you are ordering a pallet full of material from China, or if you're ordering a container full of material in China, the cost for the container relative for the amount of material that you're getting is much lower, right? So if you order more, your transportation cost tends to become lower. Also, if you have a supplier and if you have a larger order, you might actually be able to get a better price for your or a better cost for your raw material. So that if you can order more, that's great. It gives you negotiation power, because the more you order, the more interesting as a customer are you for your supplier. Yeah, right. If you buy 3 items once a month, then whatever, right? But if you buy 30,000 items once a month, you are somebody that they're paying attention to, and they will make you a better deal. I mean, hopefully. It all depends a little bit on your negotiation skills. I mean, you have to discuss it with them, and you don't. My recommendation is do it with a contract. Write it down, right? I mean, okay, I'm speaking as an American. We write everything down. In Germany, where I grew up, a handshake is good enough, right? But generally speaking, make sure that you have some sort of documentation on what your pricing is, that you don't have any surprises. You don't want any unpleasant surprises related to your cost of goods. Yeah, the same thing is true if you look at economy of scale for your production. If you improve your processes, or if you buy better equipment that helps you to make more products, and ideally with less operators relatively, right? So if you have one piece of equipment that needs 3 operators, and you buy a better piece of equipment that makes twice as many products, but also needs only 3 operators, you're essentially saving money, because you're needing less relative labor per product. I hope that explains it a little bit.
We have a few more questions in the chat, Michael.
Oh, okay, here we go. Where are we going here? Let's start with this one. Economy of scale, we have that. And then a quick question: where do business development costs fit in here? Yeah. Our partner need a lot of government lobbying, strategic partnership building, which is not exactly advertising. I mean, again, the tool is giving you just a rough idea. I would include this as your marketing cost. I mean, yes, you're not putting it on the radio, but you're spending time and money and resources to lobby with your, whatever it is, your government agency, right? So put that cost into, just treat it. I mean, for the purpose of this, the base understanding, just treat it as a marketing cost, because it's just a different pathway of marketing it. Okay, and then you say at what point do we consider the cost benefit ratio, high cost in short term and lower in the long term? I don't exactly understand the question. If you can clarify that, that would be great.
Sure, I can just unmute. Yeah, I think that's more in the way we work. We have a lot of upfront costs, especially when it's like business development costs, or even costs associated with research development, with the assumption that in a couple of years, when we are not so much in a startup phase, these costs will then lower. So I guess my question is, like, is there a good and a bad ratio here, or is this something that, like, with social enterprises especially, like how much can you go and be ambitious and put up costs up front? And same with, I think, a follow-up on your answer on business development costs is, in your experience working with social enterprises, has there been any, like, a good percentage of that for marketing and business development that social enterprises have spent in terms of percentage of their costs?
Yeah, okay. Well, I mean, obviously the development cost, or and if you look at R&D cost, for example, that varies, right? If you have one innovation in the beginning, you have a lot of R&D. After your innovation is completed and implemented, you don't need that much R&D anymore. But you might actually want to think about, okay, maybe I need R&D for my second generation of my product. So I'm innovating on top of my existing product. Important thing is like, get your first thing launched before you worry too much about your next generation. I know that innovators love to innovate, and unfortunately, innovation is like 5% of the work, and 95% of the work is like getting it into the market, which is not so much fun sometimes. So focus on getting the product to your customers, but yeah, you might have a strategy how you're going to innovate over time. If you're starting to talk to, let's say, funders that will help you for scale up or something like that, it might be a good idea to have a long-term business plan that says, okay, the first couple of years we're going to have high R&D expenses, and then later our R&D expenses is going to tone down to this, that, or the other. I mean, you know, a lot of those projections are assumptions or guesses. I mean, they're never really very hard to make very accurate. But yeah, you can take it into account. I mean, and you know, especially if you're in the service business, so if you're not selling a product but a service, it's a little bit more tricky to really figure out what exactly are the costs for the service. But in the end, make sure the most important message that I can hammer home here is make sure that you take into account all costs that occur, right? Because if you forget your R&D costs, or if you forget wages or something like that, that gives you a wrong picture of your business. You really have to understand, what does it take for my business to become financially sustainable? And to do that, you really, really need to know everything that goes into it, everything that you invest. I mean, you know, I know a lot of entrepreneurs that don't pay themselves a salary. And I mean, in the long run, that's nice, but you know, not a really good idea, right? I mean, you want to pay yourself a salary if you're working 40 hours a week or 80 hours a week on that project. Yeah, you don't want to do all this for free. So make sure that you have it all in there, and you can always, you know, with a proper business plan, you can project out. Okay, in this year we're going to do this, and the next year we're going to do that. But if you put numbers around it, and if you base it on somewhat realistic estimates on where you are today, that gives you a lot of credibility with your potential funders, because they see, oh, okay, she really understands her cost of goods right now, and you know, I understand her plan to get the cost lower, or you know, increase the price, or whatever it is. There is a question for, what do we have here? For Jamila. What was the response from your customers after changing the material? Was it more attractive, or customers were relatively okay?
Yeah, of course, we had to make it more attractive. But before we did any drastic changes, as I told you, we really went out to really see if it would be viable. We really did the bag. I wish I could show you both of them, but one of them is behind us. We just added more plastic and really made it cool. And we just changed the marketing strategy a little bit, and maximized on the fact that the recycling, they're giving back. The partnership we have right now, let me give a very good example. Serena Hotels, one of the biggest 5-star hotels here in Uganda, supported us in 2019 when we had just launched the smart bag. And before then, it didn't have solar, and it had really just 5% of plastic waste. This year, after going through all the drastic changes, we presented to them the new model and also the old model of the bag, and told them, with this, we'll be able to take up your kitchen waste, the plastic waste, add it into the bag, and there, with the people who are donating and buying the bags from here, we are being able to recycle the waste that is coming from the food they eat, and then they're adding green, clean energy. So really just not even making it look better, but also the marketing strategy for them to empathize and have a social cost to it, to make it even more fancier than the one that was selling before. So that's what we decided to do, and that's how we are putting it out. And so it's attractive emotionally, socially, and also physically. Yeah.
Yeah, that's a great point. I mean, always think about the story that you tell about your product, right? And if you suddenly say like, oh, it's much more sustainable because we're using much more recycled material, that is attractive to a lot of people, and especially larger customers who care about that or have to kind of care about that because of their corporate social responsibility obligations. Things like that can be very attractive to them. And even though your cost goes down because you use a recycled material, the value of your product actually goes up because you're delivering more than just a backpack. You also deliver a sustainability initiative. Okay. Then there was a question from Christian. A key challenge that sales cover the cost to produce and sell the product, but that grants, donations are funding, subsidizing HQ and staff costs. Yeah, well, that's what I said before. External funding, grants or donations, it's not a business model. You know, this is not something that you have under control. Well, I mean, you can try to control it, but you don't have true control over it, meaning you can't predict accurately how much donations or how much funding or grants you are getting. So what I would always do is do your cost of goods and take everything in there, take in your staff, your headquarter, everything, you know. And yes, the number will be horrible. You might say like, oh my God, I'm losing $5 or $50 or $500 for every product that I make and sell. And if you cover it in the short term through donations and grants, that's okay. But you need to have a plan in the long term that how can you cover that cost without having to rely on people giving you money for free, right? Because that's not, I mean, I can tell you that the Ford Motor Company is not counting on people giving them money for free. All those people, they want something for it, right? So you need to figure out how can you cover your cost without relying on free money. If you get free money, you can use it and you can make it, can use it to bridge the time until you become financially viable. That's okay. That's most social entrepreneurs, or many social entrepreneurs do that. That's okay. But you have to have a plan how you get out of this, because you can't build your business on living off of donation from people somewhere, right? That doesn't really make a lot of sense. And then you have here another question. How would you suggest to deal with this? Yeah, that's what I just said. So try to calculate your true cost and figure out, okay, what do you have to do to get at least to become cost neutral? If you have no pathway to ever become cost neutral and your whole business is based on donation, then you're not really, I mean, it's not really a business. It's more like a foundation or something like that, right? Because you don't really have a pathway to grow, because if you grow, then you're losing more money, right? And the whole goal of a business is that if you grow, in the end, you want to make more money. If you don't make any money and you have no pathway to make any money, growing means just that you're going to lose more money, right? I know it's horrible to say that, but you know, it's actually it's pretty accurate.
Thanks, Michael. I like how you know, I think using this tool and going through this process in the way you suggest, it can change. Even though the underlying facts don't change, it can really change the mindset. Because right now we could, you know, I could say I run an organization and I'm 50% revenue from sales, 50% grant funded. That's not so bad. I'm aiming to reduce that by 10% each year. But going through your model, we do all the costs and we say we're losing, you know, it's costing us $100 to make everything and we're only selling it for 50. Like, the facts are the same, but it's like seeing it in the way that it comes through this tool is much more dramatic, and I think it even though the facts aren't changed, the reality is more dramatic, and it helps to, I think it's more, what am I saying? I think it's just it's a really great way to look at it.
Yes, exactly. I mean, it's just a different perspective. You're absolutely right. And it helps you to figure out, do I have a pathway to financial viability, right? Or what should be my pathway? Should I increase the price? Should I lower the cost? Whatever it is, right? But if you don't have a pathway to financial sustainability, I mean, if your ratio is not 50-50, but let's say 10% you make by sale and 90% is by donations, you really have to think about, is this a business? Does it make sense to grow this? Is it sustainable to grow this? Because if you grow it, you need more donations and a lot more, right? So it helps to, yeah, I know it's not necessarily always very pleasant to look at all those negative numbers and losing money every year or every month, but it helps to guide your strategy a little bit.
It has also helped us in pitching, let's say for grants. Now I'm very clear, like if I'm to go to UNFPA and they want to give me a grant, I really sit down with them. I'm like, I turn the tables and say, this is how we are evaluating the grant. This grant will cost us this many bags, and it will pay this many staff, and it will do this much. So it's not just the grant you're giving me to cover for honoraria and all for per diem, but I really turn the fact before they actually give me the grant. It's about the cost of the bags and where they're actually going to. So sometimes if they're giving me less, I'm like, it will cover these many bags, and I do not want to tell you lies, but the more you give me, the more I'll cover this much, and I'll be able to offer this much. If you want to give me additional out of this, then let's be clear and say, this grant is going to cover these 5,000 bags that are going to cost this much. I know in this cost, I pay this much to my staff. If you want to give me more to travel with you to distribute them, put in consideration that I've put that cost in my bags, but what you'll be giving me will be maybe an addition to do more work, maybe the workshops. So I'm very clear to also now to communicate. Before I wasn't, and then I would let that just move with the air. But this really shows you exactly how it has been a bargaining chip for me as a person who meets the funders and sometimes the big corporate companies who are using it for their CSR.
And that's a really great point, especially if you do things like seminars or trainings or things like that. You can use funding to do this, because the seminar and the training doesn't really, especially if they're free, right? It doesn't really incur a tremendous amount of cost for you. But if you have funding and you spend it for that, the more funding you get, the more training can you do. But if you don't get any funding, you just don't do any training. I mean, that's a possibility that you could think about. Another one that I've seen is, especially for people who are starting to scale up and they need equipment, right? The first time you buy your equipment, that what I said before, the stuff that you have to depreciate, right? The first time you buy it, if you can get a grant to buy the first piece of equipment, that's great. You still have to depreciate it, right? Because after a certain time you will have to replace it, and you can't rely on the fact that somebody else is going to give you free money to buy a new piece of equipment. But using it for that could be a really good application for that, because if you have to have capital to start or grow your business, and the capital could be something that you tap into grants or donations and things like that. But don't use donations to cover your cost. That's not a good idea. I hope that's kind of clear. Any other questions?
Any other questions before we wrap up? Great questions so far.
Okay, thank you everybody so much for your time. I'm handing it back to Taylor, and yeah, if you have any questions, my email is on the deck. Taylor will share the tool with you. Again, it's ballpark. It's not accurate. You have to modify it to your own purposes, but if it helps you, great.
Thank you, Michael. This was absolutely incredible. The tool is going to be so useful. I know everybody can't wait to get their hands on it. And Jamila, thank you so much for sharing your experience. It's always so helpful to hear, some practical evidence and advice for how to use things and how to implement things. So really, really
Thank
great to
you.
hear from you. Thank you.
I'm really grateful for Dr. Michael. He has been such a tool, and I'm going to tie on him still the end of my business, but I hope to the success till I leave it over. So I'd love to say thank you to Taylor for connecting me to Dr. Michael. He has been quite a huge resource to us at Smart Girls. I will tell you. Thank you so much.
It's a lot of fun to work with you. So I'm having fun. So that's